What's up, everyone? It's Caddy with Money Investing. So I've got some fourth quarter 2022 numbers to share here for the S&P 500, as well as the forecasted earnings per share for 2023, and talk a little bit about how I personally believe investors right now in the markets are being blindsided with what's actually going on in the economy and with respect to earnings for the S&P 500 as well. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. And the link to our Discord and Patreon is going to be down below. If you're interested in joining us, there's very limited spots available. So if you want access to all the trade alerts, buying alerts, options alerts, not to mention the private videos, the link's going to be down below. So earnings by the numbers in the fourth quarter 2022, we did have a little bit over 332 companies pretty much mention the word inflation in their conference calls, in other words, in their earnings calls. That's a pretty high number there, and 57% growth came from energy. So if you were to exclude energy, well, let's just put it this way. If you were to include energy in the entire S&P 500 earnings, we saw a decline of almost 5%. And this is the first quarterly decline since 2020. So you can see that all the way down here, 4.9% decline in earnings for S&P 500 on aggregate. And this is for the fourth quarter 2022, the first quarterly decline since the third quarter of 2020. So it's been almost 3 years. And 67% of S&P 500 companies provided negative earnings per share guidance for Q4 above the 5-year average of 59%. So more companies providing a negative guidance. On an aggregate basis, we've got 4.9% decline in earnings. And even 4.9% decline, that's after what? That's after a 57% growth in energy. And well, guess what? That growth is going to go away this year because energy prices are rolling over and they are down. Oil prices, natural gas got devastated. They are all down in 2023. So that growth is going to go away. We're not going to find energy kind of uplifting the overall energy, pretty much earnings for the S&P 500 anymore. So that's another issue that we have to deal with. So in my personal opinion, this is an actual number. I'm not making anything up. These are actual facts that I'm presenting to you. 4.9% decline in the S&P 500 earnings in the fourth quarter. And guess what? In the first quarter 2023, we're also expecting a decline in the second quarter of 2023 as well. And this right here are going to be some of the forecasts. So this is from Yardeni Research, and then this is from the analyst estimates up top. You can see both of those numbers. And then if you come down here, scroll down a little bit, what you'll notice that in 2022, the actual numbers are going to be a little bit lower because $54.50 was expected from Q4 earnings from Yardeni Research. That's going to be a lot lower because we pretty much got a decline of 4.9%. You can see how analysts were so far off, expecting only a 0.9% decline. And we actually got 4.9% decline in earnings. And they were expecting $219.48 as a whole for 2022 earnings per share. Now, I also believe that these numbers are still too high. Yardeni Research is expecting 2023 earnings of a little bit over $225 per share, and analysts are expecting $227. Again, this is the analyst consensus number. And for the first couple quarters, you can see for yourself, first quarter and second quarter 2023, Yardeni Research expecting negative 3.3% and negative 5.1% growth year over year, and then negative 6.7% and negative 5.6% from analyst consensus. Again, this is year over year numbers we're looking at, right? So analyst consensus year over year. And we already got fourth quarter numbers to be down. That is an earnings recession, folks. That is literally if you get 2 consecutive quarters of negative earnings growth year over year, that is an earnings recession. It's pretty much confirmed at this point. There's no doubt about it. Like if you have any doubts in your mind that we're not going to see an earnings recession, I want to know why. I want to know in the comment section. So comment down below why you believe or why you think there's not going to be an earnings recession, because it's already here. We already got the fourth quarter numbers down, and first and second quarters probably most likely also going to be lower, considering that we're just coming off of very high inflation, very high interest rates, and they're only going higher. Consumer spending is probably going to run off a little bit in the middle of this year, as we've already talked about. And in my opinion, analysts have been very, very slow in lowering their EPS estimates. So if you come back a little bit, this right here has been the earnings estimates for S&P 500 for 2023. Back in June, we were at 252. Can you believe that? $252 per share. That was dropped down to 231. That was dropped down to $229, and now, as of today, it's come down to $222 per share. That's exactly what you see over here. That's the $222 expected in 2023, which I also do believe is a little bit on the high end, because if you come over here, let's just do $222. We are still trading at a little bit over 18 times earnings on the S&P 500 as of today. I mean, I'm going to be very precise here. I'm going to go with 3980 for the S&P 500, not going to go with 4,000 because, again, I was rounding up a little bit. We're a little bit under 18 times earnings, and we already know what type of multiple that is and what type of multiple we should be at considering the current macro environment. And I'll go over how this might even translate into lower S&P 500 value if there is a recession, if there's an actual economic recession in the United States. Now, this right here is another chart that I wanted to go over, posted by David Rosenberg on Twitter. Very, very interesting. That basically goes over the earnings yield for the S&P 500 with respect to the 6-month treasury bond, treasury bill. And you'll notice that these two are pretty similar. They're almost identical, and that's exactly what I have over here on this chart, because S&P 500 3980 right now. And then we've got 2023 earnings per share sitting at $222. That's the expected forward EPS. That gives us a P multiple of just a little bit under 18 and an earnings yield of 5.58%, right? That's the earnings yield for the S&P 500 as of right now for a forward basis, right? Next 12 months. So I should just write earnings yield on a forward basis, 5.58%. The 6-month yield currently trading at 5.16%. So the equity risk premium between these two numbers is come down to 0.42%. We're like so close to 0% and turning negative. It's crazy. Like investors right now they're not even incentivized. There's no attractiveness to being in equities in the S&P 500 as a whole when you've got a 6-month bond paying you over 5%. There's rationality wise, there's no rationality in staying in equities considering that 6-month yields are paying you over 5%. Again, if you're looking at on an aggregate basis, S&P 500 as a whole, not looking at individual stocks. So that's the distinction that I want to make, because I know that I'm going to get comments in the video down below. Caddy, why are you in stocks then looking at individual stocks? We're talking about S&P 500 on aggregate. They've got an earnings yield forward 5.5% with a 6-month yield sitting at over 5%, which gives our equity risk premium down to 0.42%, very close to zero. Now, the problem with this is that if 2023 EPS drops, right, if this continues to happen, like right here, if estimates keep dropping here, considering that inflation is going to be a little bit more stickier than what we anticipate, it's going to be higher, consumer spending is going to pull back, interest rates are going to keep going higher. If we actually start to see a bigger decline in 2023 earnings per share, which is not going to be unlikely considering that analysts were completely off on their fourth quarter estimates. We actually got 4.9% decline as opposed to 0.9%. And we're expecting pretty significant declines in the first couple quarters. And that could easily go into third and fourth quarter as well. And we could even see bigger drops here. If this $222 number ends up being, let's say, 200, well, guess what? We're negative for the equity risk premium, and worse, the P multiple jumps to almost 20 at current levels. 20. Think about that for a second. 19.9 at $200 EPS. That would be a little bit of a contraction year over year, coming in from about $215, $214 down to 200. Even if you drop down to 210, we're still at 19 times forward earnings, and the equity risk premium is pretty much flat at 0%. So I do strongly believe personally that this is something that will potentially blindside investors in 2023, because going over to this research from 1914, this is a lot of data put together. Every time an inflation's higher at over 4%, and we are in a tax regime, dividend tax and capital gains tax, which are higher or lower considering, which environment we're in. Right now, I can argue that we are in a high tax environment. There's been 26 years of this sort of environment, 26 years where inflation was above 4% and we were in a high tax environment. The average P multiple was 11.2. Even if we don't go that far, even if we don't go as far as 11, even if we don't go as far as 14, let's just go as far as 15, right? If we go to 15 times P multiple, right? That's going to be that 15. And you multiply the EPS, 2023 forward earnings per share, that's your S&P 500 value. That's all based on math. Again, I'm not making anything up. That's literally based on math here. 15 times. Even if we go to, let's say, 16, we're being generous at 210, that's your S&P 500 value, 3360, right? That should be the SPX value. This is where it should be trading at. Instead, we are trading at 3980. So that's what I want to get across here. I just don't want anyone to be blindsided by this. And this right here is Yardeni's S&P 500 forward P multiple expectations between 15 and 17, right, for 2023. So you can already start to see, like, if expectations for P multiples are between 15 and 17, how come we're trading at 18 to 19 times P multiple and having a higher earnings per share expectation for 2023? Now, in terms of recession, now I want to jump gears here a little bit, talk about recession here. There's probability for recession in 2023 has increased to 64%. That's the odds, with a terminal rate for the Fed funds sitting at 5.25 to 5.5%. That's the peak. And this is a survey that was done from the Economic Indicator Survey from December 12th and 19, 2022. And a lot of economists participated. And 62% of economists who say the Fed probably won't cut rates until 2024. And if you go over to some of the other U.S. recession probability models, this is from the Conference Board predicting a 96% probability that the U.S. is going into a recession within the next 12 months. And the reason why I'm talking about recession is because I feel like there's been so much optimism in the markets over the last couple months that a lot of people have forgotten what the actual reality of the situation is with respect to recession, right? With respect to earnings recession. That I already mentioned. It's facts. It's already here. We already declined in the fourth quarter. We're going to decline in the first and second quarter. When it comes to an economic recession, sure, there can be debate around that, depending on what you think is going to happen versus what the analysis is versus what the Federal Reserve ends up doing. But this is historical S&P 500 corrections since 1965. And when there's been a recession versus when there's not been a recession, in other words, a bear market which has been accompanied with or without a recession. So every time you'll notice that every time we see without a recession, the average decline has been 15.4% and the average length has been. And this right here are going to be S&P 500 corrections and bear markets, which have been accompanied with or without a recession. And again, every time you'll notice that every time we see a correction in the S&P 500, which has been accompanied with a recession in the economy, obviously the declines have been much more than when we have not seen a recession, right? So this right here is going to be the bear market. So with or without recession. So every time we've seen a recession 12 times since World War II, accompanied with a bear market, the median decline has been a little bit over 36%. Of course, with a no bear market, we've seen only a decline of 15%, which is very much in line with what we have seen over here. So the bottom line is that if in 2023 we end up seeing a recession at some point during the year, whether it's the middle of this year or the end of this year, the earnings recession's already going to start after the first quarter earnings are released. So think about it probably around April, May, when companies start reporting earnings for the first quarter of 2023. That's when I believe the earnings recession will begin. And then at that point, after May, we'll kind of reevaluate where the consumer spending is. Retail sales, we'll talk about PMI manufacturing index numbers. We'll talk about the housing market. And we'll also pay attention to inflation, where we are 6 months from now with respect to interest rates as well. And then obviously look at GDP numbers to better assess whether we get an economic recession or not. The probability is high. Yield curves are inverted. A lot of metrics, a lot of indicators are definitely suggesting to a potential recession in the US in 2023. And if that ends up happening, I would not be surprised if the markets do drift a little bit lower and maybe even breach October lows. No guarantees on that, but I wouldn't be surprised if that happens. Just want to prepare you guys. I'm prepared. Let me know in the comment section down below. What do you think about the markets in 2023? As always, happy investing. Make sure that you drop a like, subscribe, and I'll see you guys in the next video.